Let's bring in now DoubleLine Capital CEO and CIO Jeffrey Gundlach. Jeffrey, welcome back for our traditional visit.
Hey, Judge. Good to be here again.
It's good to have you. So what is your reaction to what the Fed chair had to say today? He used a couple of R words, the one we talked about last time, recalibration, and then remarkable, he said, when describing the resiliency of this economy.
Yeah, recalibration showed up again, and that's a repeat of the last meeting's sort of word of the meeting. And I think Powell feels very much that he's in a good place now, because since the July 31st meeting, we have the two-year Treasury rate is up by almost 60 basis points, and the Fed funds rate is now down by 75 basis points. So he's gotten much more in sync with the bond market by a movement of Fed funds relative to 2 years of 135 basis points of convergence in just basically two meetings. So I really think that we probably have one more rate cut coming in December, because that would true up the Fed funds rate with exactly where the two-year Treasury rate is right now. So it is interesting that we've had such a strong performance of the stock market since the last Fed meeting, while we've had interest rates rising. So you've had a tremendous outperformance of stocks versus at least Treasury bonds since the last Fed meeting, and I attribute that basically to the election result. So we had an incredibly consequential election result, very different than a lot of people probably were forecasting as a base case a few months back. And we've had one of the least consequential Fed meetings today, with basically a repetition of this idea that the goals are normalizing, the labor market's normalizing, the quits rate and the job openings rates are kind of where they were pre-pandemic. And so I think the Fed is feeling very much that they are plodding along towards their goals, and he said so in fairly direct language today. So yeah, the thing that's sort of surprising me a little bit is that people are so willing to dismiss the softening jobs market. I mean, the 12,000 jobs, I know people want to attribute that to one-off hurricanes and strikes and stuff like that. But I keep looking at the household survey, and the household survey over the last 11 months has been a loss of jobs of over 300,000 jobs cumulatively over the last 11 months. And so that typically is a little bit more real time at economic turning points. It's still not terrible, the household survey. It's very volatile, so we have to watch out for that. But it is not showing tremendous signs of strength. And the real problem that the bond market seems to be having, from my perspective, and it's being talked about much more in the open, it came up several times at the press conference today, is that the supply of Treasury bonds is getting to be rather astonishing. We have a $2 trillion deficit. It's about 6% of GDP over the last 12 months, and we still have a growing economy. And the interest expense on the debt, which I always talk about, 3 years ago was $300 billion per year. It's now $1.3 trillion per year. And we have a great volume of bonds that are rolling off with very low interest rates from 5 years ago, or even 3 years ago, that are being refinanced at substantially higher rate levels. And this is going to continue to be a supply problem for the bond market. And for this reason, we are not positive on long-term Treasury bonds. In spite of the fact that the economy is sort of gradually slowing down, it's just the supply of bonds is very troubling. And so we recommend investors stay at the intermediate part of the Treasury bond market and not out in the 20 and 30-year bond sector. In fact, when we were at the low in rates, basically several weeks ago, we made another duration cut or maturity cut in many of our bond funds, because we do not want to be exposed to this fiscal financing problem, which I think could very well lead to rising interest rates in spite of the fact that we might have a slowing economy. So interest rates are rising. We have the curve is not inverted anymore, 2s to 10s. It's not very positively sloped. It's a very flat yield curve, and we're anticipating that the Fed will cut rates again in December. So not a lot to take away from today's meeting. It was pretty much a repeat of the comments that were made by Jay Powell at the last meeting. But I do think that he is much more in line with the bond market, and he is correct in exuding the idea that he's a normalized sort of a place, and that he's making progress towards the mandate. The inflation numbers are lower, of course. The PCE core is at 2.7. There are some inflation numbers in the low twos. We believe that if we keep the price of oil around the low 70s, which has been a lot of resistance down at around 70, we think we're going to see potentially a headline CPI that's below 2% in about 4 or 5 months, based upon the structure that's there. So Jay Powell will be able to pretty much declare a victory. I also commend Jay Powell for bringing up the lags on the rent rolls. The part of the inflation rate that remains elevated is kind of rent rolls. The new rents have almost no inflation, but the old ones, they come down with a lag. And so that part of the inflation picture is probably still going to provide something of a ceiling on where the inflation rate is going to be for 2025. I don't think under the base case we'll see a 3-handle CPI inflation rate during the next 12 months.
I mean, Jeffrey, we talked about the backup in yields. You certainly did. I mean, what role do you think that might play, if any, in where policy does go from here? Powell said, quote, "We're watching that. We'll see where they'll settle. Right now, it's not a major factor in how we're thinking about things." Do you think it needs to be a bigger factor?
Well, I think that one thing with the Trump election and the Senate going to the Republicans and perhaps the House, if the House goes to the Republicans, there's going to be a lot of debt. There's going to be higher interest rates at the long end, and it'll be interesting to see how the Fed reacts to that, because Trump says he's going to cut taxes. At least he said so in the campaign, and he's very, pro-cyclical stimulus, as basically it's in his DNA. So it looks to me that there will be some pressure on interest rates, and particularly at the long end. So I think that this election result is very, very consequential. And I think most people were surprised at how widespread the strength was for the Republicans. And maybe it was just a denunciation of all the lawfare. I think that was a really big issue in the election. People, all these crazy lawsuits being filed almost on the same day back a year ago. And people just don't like that. People don't want this kind of strange manipulation. And I think that Trump's authenticity is something that attracts people. Unfortunately, he's very outspoken about the types of policies that are very stimulative that he wants to put in. And he's always been a debt guy. So I'm really worried about that. I'm glad that Elon is somewhat associated with this administration. I mean, they're talking about looking for some spending cuts. That'll be really interesting. I mean, Elon, if you're listening, give me a call. I can help you try to find $1 trillion or $2 trillion out of spending cuts, because we certainly need that. But I think that we have a risk here of there being a backlash from the bond market. And the stock market has done so well since over the past couple of months, and the bond market has not done very well at all. And it's starting to be kind of an interesting valuation issue. I think Goldman Sachs, put out a paper talking about forward returns and how bonds are very, very competitive given the yield to where they are today, where you can get 7% yields out of not terribly risky, say, double B type of a corporate portfolio. And I think it's quite likely that bonds will be much more competitive going forward than they were. But in particular, what's interesting is that the spreads on corporate bonds are very, very small in terms of the incremental yield versus treasuries relative to history. They're almost where they were really at the lowest. For like junk bonds, it's only about 270 basis points higher than treasuries. Investment grade corporates are inside of 80 basis points over treasuries. But I don't think that that means you should be avoiding corporate bonds. I never liked the really low rated stuff, the triple C's and all that. But in single B, double B, weak triple Bs, I really think that there's a reason why spreads are so tight. And it's because I think the corporate bond market is less risky on a relative basis than the treasury market. It almost reminds me of where it was back at the beginning of my career when Reagan came in, people were worried about the deficit, and you had the higher quality bonds, like IBM, for example, I remember at the time, actually yielded less than treasuries. because people thought IBM was safer as a borrower than the Treasury market. And I think that's one of the things that's propelling this corporate bond performance that's been very, very strong. The reward isn't very high, but the risk isn't very high. These corporate treasurers are smart. And when rates were so low, I mean, when 3 years ago, the high yield bond market, believe it or not, yielded 3.5%. And so these treasurers locked in these very low rates, and there isn't a maturity wall coming for the next few years. And so it'll be interesting to see how the spread markets change. And we've already seen pretty much spreads tightening across the board on non-treasuries. It's the treasury market that's been the underperformer in recent months, and I have a feeling that could continue.
So you told me prior, and I think you alluded to it here when talking about the tax cuts, you told me you were not in favor of re-upping the Trump tax cuts. So he obviously thinks he has a mandate. He may, in fact, have a wide enough margin in the House by the time this is all said and done to do that. Do you stand by that view that they shouldn't do that? And I also want to know what you think about that Larry Fink op-ed in the Journal the other day regarding the deficit, which you are obviously concerned about, that essentially you can grow your way out of this deficit problem. You just have to have a higher nominal GDP growth, in fact, to do it.
Yeah, I actually agree with that point, except there's a caveat, and that is we have to stop this deficit spending. Jay Powell said this in the press conference, to his credit. He said, we can't keep spending $2 trillion more than we're taking in. The math just doesn't work. Ben Franklin said one of the great natural wonders of the world is compound interest. But when you're compounding your debts, you're running into a real, a parabolic compound interest curve that's working against you. So we really need to have less of a deficit, and I don't think that's going to happen in the quarters ahead based upon the strength of Trump in this pretty resounding victory. I think Harris actually underperformed Biden in just about every county in America. It's kind of hard to believe it could be that widespread. But the lack of authenticity from Harris was really kind of fatal. And of course, she had an albatross around her neck with a approval rating of her boss that was just mired at 40 or lower for the last few years. So she really had an uphill battle that she was forced to climb. But I think that we're not going to get better news on the deficit in the first couple of quarters, maybe first year of the Trump presidency. I really do not want tax cuts, frankly, for anywhere in the economy, because I don't think that we can continue on this path. And if we re-up the tax cuts, that just means that we're extending the timeline on this deficit problem. I'm actually writing, it'll be out in the public in about a week or two. I'm writing my own white paper about the debt crisis is starting to come much more in focus. And I run through some basic arithmetic on that, and it's really rather sobering. So I do not like long-term Treasury bonds. The last thing I did relative to long-term Treasury bonds was to sell them.
You had been calling for a recession at some point. Do you still think one's possible, likely, or do you think that the election of Donald Trump changes the calculus because he's going to theoretically have a more pro-growth agenda, if you will? You certainly would have. You have a lot of pent-up demand as it relates to M&A and other things. How do you view that now?
Yeah, I think that's right. I think Trump, it's clear by the action of the stock market, not just yesterday and today, but really over the past couple of months as the support for Trump was on the rise kind of steadily for the six to 8 weeks prior to the election, we see tremendous outperformance of stocks versus bonds. It's getting rather stretched, but I do think that it's right to see the Trump victory as reducing the odds for near-term recession fairly substantially. And so I don't really like the way it's going to be accomplished, because I think that's going to lead to this problem on long-term bonds. But we'll see what happens. Certainly the odds of recession drop when you have this type of an agenda being promoted in plain English for the past 3 months by Mr. Trump.
Does it change the trajectory of the dollar, which is obviously one of those trades that had been a so-called Trump trade. We saw the dollar index rising, and it seems to be on a higher trajectory from here. Is that what you see?
The dollar seems to be extremely correlated to interest rates. If you take a look at the chart of the DXY index and overlay it on the chart of, say, the 10-year Treasury, it's the same chart. So what happens is our interest rates, have been going up, and that's supportive of the dollar. If I'm right, and there's still some potential for long-term rates to be suffering under deficit fears, then the dollar would probably still go higher. And so for the time being, we've been neutral on the dollar for much of this year, and it's been trading in a range between about 108 on the DXY index and 100, and lo and behold, right at the dead center of that range, very nearly the dead center. And that's the same on the 10-year Treasury yield. It got down to 360. It's been up at around 5% or so, and we're right in the middle of that. So the dollar is extremely influenced by movements in U.S. Treasury rates. And so I believe that is going to continue to be the case because it's been an extremely strong correlation over the past several quarters. And there's no reason to believe that's going to change.
It seems as though you think that Chair Powell at this point in the cycle from, when we started doing these interviews a couple of years ago, it feels like at this point, can he at this point declare victory? He obviously said today explicitly that he wasn't. And some like Stan Druckenmiller this week suggested that they might try and do that a little too early. But does he have a right at this point to declare victory given the trajectory of inflation, where the economy is, again, using the word remarkable to describe it? Should he?
I think it's a little early on that, but I think he'll be able to do that come, say, March or April of next year, unless we get some sort of a shock to commodity prices, particularly the price of oil, because we're going to get, on the headline CPI, we're quite confident, given the current structure of the commodity complex and where rents are going and the like. We think that the CPI is going to have a one handle on the 12-month headline number come March or April of next year. And if that happens, well, then I think you can start talking about declaring victory at that point in time. I think it's too early now. He's too prudent. He's too careful of a Fed chairman to make that assumption. He says we don't predict, we don't assume. He said those words in the press conference. I applaud him for that. But the trajectory he's on, he's getting closer. When we started these conversations, the Fed was so far behind the curve. They were so loose compared to the obvious trajectory of inflation. And then he was too tight. And now he has gotten himself, begrudgingly perhaps, but he's got himself almost in line with, I've said this almost every conversation, Scott, the Fed follows the 2-year. And I know people push back against me, but I can prove it mathematically, and it absolutely follows the 2-year, and he's almost exactly in line with it. So Powell is in the right spot where he is. He says the labor market's normalized. I agree with that. The inflation rate has been coming down. I think he deserves credit for what he's done once he finally started cutting, and now he's cut 75 with the 2-year going up. He's right to be in a relaxed frame of mind, and his mood and demeanor in the press conference were very good. I thought his answer to "Are you going to be demoted?" or "Would you step down if Trump asked you to?" I thought that was a great answer. Just no hand waving, just no. He's not stepping down. I think that's good.
Yeah, I think that's why we played it. It had a bit of I don't know drama necessarily to it, but the way that the chair answered that. I mean, how do you view that? I don't know if it's a wild card or not. That Powell obviously thinks he has some room ahead to continue to cut rates, right? He made that clear. He thinks they're too restrictive. To the degree of which they are, that's still unknown. But he also is potentially going to be dealing with reflationary policies from a new president at a time where the economic backdrop, Jeffrey, is pretty good. It just creates tension, I think, in the relationship, if you will, moving forward.
Yeah, I think that's right. I mean, I think there is a risk of a reflationary policy. We don't know what the tariffs are going to look like. They could be, surgically applied, which would be great because that's kind of where it was the last time. or they could be, just very heavy-handed. That would obviously be potentially inflationary, depending on what method is used on these tariffs. And of course, tax cuts that he's talking about are horrible for the deficit. So we've seen that, and I'll just repeat it one more time, as Trump became more likely to win, we've seen rates go up, and we've seen, in spite of those rising rates, we've seen stocks going up. So it's been a very obvious sort of a Trump trade. I don't know why that one should expect that to change in the near term. I mean, we have to see what happens come January, third week of January. But I'll be monitoring the rhetoric that comes out of Trump very carefully. And he will be probably trying to browbeat Powell into being less restrictive, if possible. So it's going to be an interesting time period here. We've had quite the week. I think Powell looked a little tired. I think a lot of people had a late night on Tuesday. And so this meeting is really very inconsequential. I think what we see December and then the first meeting of 2025 is really going to be very important.
In terms of I guess the drama between President Trump and Chair Powell, we've seen this movie before. We'll see if the sequel is nearly as dramatic. It'll be fun to watch. Let me ask you this: of the Trump trades, if you will, the one that we saw to the downside was China. You've told me for many months that you liked India. Do you like it more today because you anticipate higher tariffs on China? How do you view that whole paradigm?
Well, I like India a lot for the long term. I mean, it's obvious that they're on the ascent, not just demographically, which is extremely strong demographics, but they're clearly a beneficiary of production shifting away from China, as is Mexico probably. So I think that that's not something that I even think about as a 3 month or 1 month. I'm talking about a multiple year horizon. And I just think India is a great place to be for the long term. The dollar is very stable. Oil has been very stable. It's really remarkable how we've seen such volatility in gold and silver being up so much. Now Bitcoin is on a moonshot.
I was going to ask you that.
This is all, I think. Yeah,
I was going to ask you that. Did you go out and buy some Bitcoin on Tuesday night?
No. I have no interest in cryptocurrencies, but I do think that it's interesting that gold has been rising and silver has been rising relentlessly pretty much all year. And I think that's an anti-deficit, anti-central bank type of a mood that's going on. Central banks are buying gold like crazy. Retail buying, even Costco is selling gold, and they can't keep it in stock. I think people are viewing Bitcoin and gold as not speculations as much as they were 5 years ago, but more as permanent portfolio allocations. And I do have gold in my portfolio, so I continue to hold gold. Bitcoin is for I'm a coward. I can't stomach that type of volatility. So that's why I do bonds primarily. Let the momentum guys have their fun, but I'm a value guy primarily. And so I don't have a mechanism for valuing fair value on Bitcoin, so I stay away.
All right, we'll leave it there. I think we covered so much. I so much appreciate your time as always, Jeffrey. Thank you.
All right, we'll see you in December. I guess the next one's what, December now?
Yeah, I guess December. So. Yeah, we'll see you in about a month.
Yep.
See what happens.
All right. Good luck, everybody.